Thank you very much for joining for episode 19. Today, we're going to talk about how to apply reinforcement learning for fraud detection, decision insurance. So if we talk about fraud detection and insurance and any really outlier detection problem, the similar thing here could be applied to any type of outlier detection, including loan approval, credit approval, security, looking for network packets out of the ordinary, could be applied to medicine, looking for if you're sick or not. So anything that includes an outlier decision. So we believe that fraud detection, risk management, any adjudication type decision where you have to decide yes or no is an outlier detection problem. And I know in retail, we spoke a lot about retail as dominated by interactions because it has the halo effect and product interactions. A lot of businesses like banking, insurance, medicine, security are outlier detection dominated businesses. And both businesses have elements of each. In retail, outlier detection, that element of retail is the fact that 10% of your customers spend 50% or more of the dollars. And insurance and banking, there is an interactive effect as well, because if you wrote somebody a collection letter on Monday and then you marketed them a new banking product on Tuesday, those two things would interact with each other and have a negative effect on the customer's business. So all businesses have an element of outliers and interactions, and in some businesses, interactions dominate, and some businesses, outlier detection dominates. And I'd say today, when we're talking about fraud detection, it is an outlier dominated problem, in that looking for fraud is looking for outlying events or entities in the database and then making a decision to say pay or not pay based on the fact that it's fraudulent. But to start with kind of a simple analogy, so let's say the fraud is an underwater mountain. So let's say all the ocean floor, all the mountain, that ocean floor is the fraud. And, we've covered the ocean in water, and we're saying, can we find the ocean floor, or can we uncover peaks that stick out of the water? Now, so today, if you do the simplest fraud detection capabilities, maybe only a few peaks are sticking out of the water. We know that 2/3 of the Earth's surface is covered in water. So 1/3 of the Earth's surface is sticking out of the water. And we call that, let's say that's the fraud. That's the fraud that we can easily uncover because it's obvious, it breaks obvious rules. And so that's where we start. And as you increase your fraud detection capability, you're in essence lowering the water level. And as you lower the water level, you uncover more and more fraud, and you increase the fraud detection capability by using more and more sophisticated methods, right? And you continue to reveal more fraud eventually until you empty the oceans and you see all the fraud there. Now, the challenge then becomes that you have so much opportunity to investigate, you'll create this growing backlog of investigative work. And we know from our experiences working with our insurance clients, we can generate more alerts and suspicious events or people or entities or claims than can be investigated. So how do you address this volume of investigative work? Well, two things you can certainly do. One is streamline the workflow, make sure that the investigative tools, workflow, and processes that you use are very efficient. And so we know one of the things, by centralizing all the data around investigation in one place, like having an investigation fraud detection platform, that streamlines the workflow and saves investigators and adjusters time because they don't have to go to multiple systems to get data. So bringing all the data together in one place is a good thing. So that saves a lot of time, and we've heard feedback from our clients that we've been able to save substantial investigative time because we make it easy to get all the data required to investigate a potentially fraudulent claim or to make an adjudication decision around whether a claim should be paid or not. The second thing you can do is prioritize investigation. If you decide it's not possible to go investigate everything, and maybe it's not financially worthwhile to investigate everything. If you had a fraudulent claim worth a penny, that might not be worth the effort to go get that. Obviously an extreme example, but you wouldn't go after, spend energy to detect fraud that was low value. So there'd be kind of low value claims. And so if you're going to apply human effort to investigate fraud, then you might want to apply that only to the most complex, material, large dollar value things out there. But the real challenge, I think, in the industry, and as we adopt AI, is to automate decision making. Let the AI decide, let the technology make a decision, and you can set a certain subset of claims or people where you allow the technology to make a decision. Maybe that might be those patterns or situations that you are very confident in the technology, or maybe the dollar value materiality threshold is below some dollar amount that you don't have time to look at anyways. So setting some kind of rules around where the AI can make autonomous decision making, that's how you get at the bulk of it. So if you're creating tens of thousands of alerts a day in the system, obviously you don't have enough investigators and adjudicators to look at all those. So if we could say let the technology auto adjudicate 10 or 20% of those, the investigators maybe have the bandwidth to look at 10 or 20% of those, and then we do our normal treatment on the balance, which is what happens today. Today, the vast majority of claims and entities are not being looked at because it's just not the bandwidth to look at everything. And so there is a prioritization effort. So we can continue to improve the technology, streamline the workflow, prioritize properly using the analytics, and the AI system can also help prioritize. But ultimately, to really get at the lion's share of this requires companies to trust the technology enough to be able to automate those decisions. And ultimately, the technology vendor's job is to help build that trust. And I know I've spoken in previous talks about the trust building journey. And I think that's an important part, that we can build trust together to then allow more and more automation to occur. So AI, if I was to lay out kind of analytics in a spectrum, looking at this graph here on the horizontal axis being, as you go to the right, the degree of intelligence in the technology increases. As you go vertically on the vertical axis, the amount of competitive advantage or financial ROI that you gain goes up. And if we were to divide analytics into three buckets, we have business intelligence on the left there, where you're doing standard reporting, answering questions like what happened yesterday, how many, how often, where exactly did it happen, what actions are needed. This is basically business intelligence, operational reporting. You're monitoring things as you go along, and alerts would be simple rule broke, like if claim was filed on a dental patient and you've pulled the same tooth twice and you've already paid for the tooth the first time, then that's likely a rule, an alert that could generate fraud. So this is kind of standard business intelligence that's been done for decades. And now if we get into kind of advanced analytics, statistics, maybe machine learning, you're start to ask questions like, why is this happening? Doing statistical analysis. Prediction and machine learning is trending out, predicting the future. Can I take this, why this is happening, and project it forward and say, will this continue? Or what should I do with this next claim coming in? Optimization would be answering the question, given the past, what is the best that can happen over the next year? So then optimization decision making. Narrow AI is answering what is the best that can happen over a year, not necessarily limiting it only to what you've done in the past, because you've created now dynamics of the business. You can simulate situations even that haven't happened. So the idea is with narrow AI, you can say what is the best that can happen over a year. And this would be kind of the growing sophistication of analytics as you keep going up, and there's more and more potential value as you increase the analytics. And then finally, I think the most important thing that's not talked about enough is integrating this into business operations, right? So executing, if we can integrate into business process operations, we can execute the best that can happen. I mentioned there under narrow AI, fuzzy logic, because I'll talk about that. That's a branch of mathematics that we use for reinforcement learning in AI and insurance. Now, if we integrate narrow AI in a business process, maybe in a case management tool in insurance, that's some of the workflow. And as you want to be able to execute on the recommendations of AI, be that automated or be that surfacing AI recommendations to adjudicators and fraud investigators. And ultimately, you want to integrate that into your financial processes. So the actual decision of paying or not paying, when you integrate the business process into that financial adjudication, then that's kind of where you talk about automated adjudication, be that for auto deny for fraud or to auto process a payment or auto deny a payment. Even if it's not fraud, you may not pay because the coverage is not available to do that. And ultimately, this is where you need to integrate the technology with business and financial processes, and that will generate ultimately improve business process outcomes. So regardless, even if you're not doing AI and you're doing statistical analysis and prediction or machine learning, you should be integrating those into existing workflow and financial processes to achieve the values, not just a technical exercise. So those are just some background definitions. Going back to remind you what we view the key defining features of AI versus predictive analytics or statistics. If you only analyze historical data, that's called statistics. If you're doing it with labels, that's supervised learning, prediction or classification or machine learning, we call that. Without labels, maybe it's called clustering or feature detection. The ability to learn from the past and simulate even without the past, learning is exploiting what you know, and exploring is simulating new things that you may not have experienced before and remembering the results of these explorations and exploitations. That's called reinforcement learning, where you're applying the exploration. The ability to simulate the future and take results for actions that you've never taken before without labeled training data. Simulating the future means you can learn faster than the pace of time. If you've got the dynamics of the business, we can simulate the future and say this is what would happen and this is what you should do. And you can learn faster than the pace of time, because with computers, you can run 1,000 years in an hour if you have the computing power to simulate 1,000 years of the future. The ability to make decisions autonomously with no human in the loop, we think that's a defining feature of AI. And the ability to trade off short-term rewards for long-term gain. So make a bad decision now, let this fraudster commit a little bit of fraud, so maybe you can expose a whole network of fraudsters, and that you get a much bigger gain if you make that happen. So being able to trade off, like in a game of chess, you might sacrifice a piece in the short term to win the game 10 moves down the road. And so that's the idea of being ability to trade off. So these are some of the definitions that we use to define AI and how we define it differently than maybe the market, which is very general definition of AI, which includes a lot of things. Okay, so in DAISY, our AI system uses 5 kind of analytic techniques combined together using fuzzy logic-based outlier detection. And so I'll go through each of these methods. So essentially, we use rules, or we create probabilistic rules from standard if-then-else logic, which is kind of that I talked about BI monitoring. So we fuzzify the rules, and I'll talk about that a little bit. And that's based on what you know. You need to have past learnings or labels. Then there's supervised learning or predictive modeling, or called machine learning, where we can identify patterns associated with historical labels and make decisions based on that. I'll talk about we use the output in a different way. Then we do social networking, where we connect individuals or claims together in non-obvious ways. And then we do peer analysis, is looking at entities that are different than their peers. This could be people, it could be a claim itself. Is this something different about this claim, or different about this person, or different about this network than everyone else? And so on the right-hand side, this is things that you don't necessarily know. On the left is what you've already know, like to build a predictive model, you have to have lost $1 million already to build a predictive model. You have to have labels, whereas to do peer analysis, you don't have to have lost anything. We can find the first instance of a new fraud. And we combine all of this together using outlier detection. So all of these analytical methods create features. So we use predictive modeling as a feature in a fuzzy logic system. We use a rule firing as a feature in a fuzzy logic system. And there's some benefits to that. I get into that. And so by using all of these methods and combine them using fuzzy logic, we create a suspicion index that is the combination of all these methods. So this reduces the false positive rate. If all of the methods agree, 10 predictive models fire on a claim, the people associated with the claim are outliers compared to their peers. The claim and the people associated with the claim are part of a sophisticated fraud ring, and 10 fuzzy rules are broken. If all 4 of those things happen, then this is likely an outlier record and there's no false positive. And this is how we can prioritize claims. We can also automate the decision, because now all 4 of these general classes of methods found this to be suspicious. Therefore, the false positive rate's low. We can feel highly confident. We can automate the decision with no human intervention. So this is how we build an automated fuzzy logic detection system using all the different methods here. And I'll dive into kind of each method one by one.